Good morning, traders. Today is June 26th, Sunday, early in the morning. Last week, I highlighted this move in the S&P, the E-mini futures contracts for the S&P, and highlighted the point that from this move here, this peak in March 29th to the low here on May 2nd, represents the exact same price move from this move here, May 31st, down here to the low on June 16th. And that this recovery phase here would likely get mirrored in this recovery phase here, representing a roughly 1.5 to 2% upside move. Well, last week on Friday, we saw a big move to the upside. This is a daily chart. And you can see here, when I did the update, we were talking about how this could recover back to the upside, targeting this area here, this 39.29 or possibly a little lower, 3,900. And we've blown right past that on strong buying last week, which I believe is really a relief rally in a downward trend. And if this move were to mirror this, continue to mirror this, we're now looking at a peak. This is the top. This is likely going to be a fairly strong downside move, and it's going to end up somewhere around 33.90 or 33.95 down in this area. My Fibonacci price modeling system is suggesting these target levels on the daily basis, and this puts us right in the middle of this lower channel, which would be a fairly strong bottom in the market. It would also complete, if I can highlight this, it would complete a downside 5 legs. So we have leg 1 down to here, 2 up to here, 3 down to here, 4 up to here, and 5 potentially down to here. That would set us up for the potential of a moderate recovery phase in the S&P, somewhere from about here, maybe back up into this 4,200 area, testing this support channel or resistance channel right across here. Try to draw it for you. Right in this area as a resistance channel. And I believe this is very close to a downside rotation here move. Now we have this being labeled as a ultimate bottom with this white label. This is an ultimate bottom as it's forming. This Fibonacci system is kind of like an Elliott wave. Excuse me, got a little phlegm. When we take a look at this, you can see long term, if I go all the way back, you'll see the COVID low points us to a bottom. And I'll just show you how this works a bit. So you can see here that this points us to an ultimate bottom here, an ultimate peak here. And then we have these rotations. So you can count these little dots in between. So this is an ultimate top going down to a primary low or a pivot low to a pivot high to an ultimate bottom. And then we come up here to an intermediate peak here. So we count these dots. We go up to an intermediate high, intermediate low, intermediate high, intermediate low. So you can count these as A, B, C, D, E to an intermediate peak. That's a 5-wave uptrend. And then we have a complex wave structure up until we get to this intermediate low, which is found here, up to this intermediate high. And then we come up here to an ultimate high. So we get these rotations as we go. So obviously what we're seeing here in this ultimate peak here, when we take a look at this, we're getting an intermediate low, intermediate high, base. Intermediate low, intermediate high, intermediate low, peak. So this is an interim market peak. We're getting an intermediate low, intermediate high, intermediate low, intermediate high, which will eventually form when this new rotation sets up. And then this will potentially ultimately be a 5-wave down cycle from here. So understand that this is going to be potentially an A, B, C, D, E 5-wave down to here. Then we'll go ahead and see it rotate. So we should see here A, B, C, D, and then we'll probably come down to E here. which will set up the end of this move. Now, the way this is being counted is an ultimate high here and a wave 1 move here. So this sets up wave 1, wave 2. I'm counting it as wave 3, wave 4, wave 5. But we'll have to see how this plays out. If this is a wave 3 structure combined, then you need to be aware that wave 3, if this is a wave 3, sets up a potential wave 5 roughly equal to what wave 3 would be. So if this is our potential wave 3, and then this is our potential wave 5, oops. See if I can put that back and drag the right one. There we go. Nope. It's too tight. I'm grabbing all these crazy little lines right here. Need to make sure I get the right one. All right, let's just spread this all the way out. And so we have all kinds of lines here. Let's get rid of that one. And let's duplicate this one again. And if we were to see a wave 5 move from this level, then what we would be looking at is a downside move to 2910 roughly. So if wave 5 is exactly the same as wave 3 in length, which is sometimes the case, obviously wave 3 should be the longest, wave 5, well, wave 3 should be longer than wave A or wave 1, and wave 5 can often be equal to wave 3 or longer. So we have a potential here for a very clear downside move, which would be roughly from the peak area down to this area, be about a 40% downside move or lower down into this 2400 level, maybe, as the market continues to move. Okay, let's get over here to the charts. First, we're going to go with the 401k deployment gauges. This is updated for June 26. U.S. markets bounced a bit higher last week as traders pulled billions away from the U.S. stock market. This is retail traders are pulling away from the market right now. I see this as a major reversion in a downside price trend, which we just went over. This upside move is really just a bounce in a downward trend. I urge all traders to stay cautious of greater market risks as the unwinding of excesses continues. Gold and silver need to hold up near recent lows. Bonds may be starting to come to life again. Huge opportunities are about to unfold. Stay patient. The most important thing I need you to understand, everybody, is that we got out of the markets very early in the middle portion of last year and have moved into this hedged position and stayed properly hedged right now. We are not going to be jumping into stocks. We have only a 10% allocation in stocks, which allows you to trade very small percentages using my TT scanner or live trades setups. So you're risking a very small portion of your capital. We have most of our capital in cash and metals. We have a very small position in bonds because bonds will come to life. They will become a safe haven. Right now, the U.S. dollar is acting as a safe haven. Metals are holding up very well, and I'm going to show you what metals may continue to do going forward. We've seen some decline in metals, but we've also seen copper move lower, which is a very good sign that the markets are entering in into a very extended depreciation phase, very similar to 2008, 2009. And if you remember anything about 2008, 2009, you must remember that gold and silver shot through the roof. Now, what actually caused that? You have to understand that what's going on right now is that the global traders perceive the central bank as still having some control over what's going on in the economy. And this is why gold and silver are staying relatively muted right now, is that fear has not really elevated. We need to understand, though, that another shoe is likely to drop. I read today that Russia is only hours away from potentially missing a debt payment. I believe that similar types of situations are going to happen across the globe. There could be another Lehman moment in the works that may only be 10 or 20 or 30 days away. What the Fed is doing right now by raising rates is likely going to push debt holders into a very serious scenario. For example, renewing the debt or rolling over the debt is going to cost them quite a bit more now with higher interest rates throughout the globe than it did back when interest rates were zero. And this is something we need to be aware of, okay? The Fed is raising interest rates. Global central banks are raising interest rates. We're in a very debt-heavy society right now. Corporations, governments, home builders, you name it, they're all floating bonds. They're all carrying debt. And a lot of them are going to need to be able to restructure that debt in some way, shape, or form. And that normally means either paying it down or rolling it over into new debt instruments, which is going to require a higher payout. And that's going to be where we're going to start to see some real crisis event start to unfold. The Fed's only started raising rates a couple months ago. So I'm not expecting to start to see some real contagion events until the end of this year, near the end of this year. So we just need to sit and be patient. The opportunity is going to come for us to jump in right now. But as I showed you on the charts, we're just not there yet. And my analysis is telling us that we have more downside risk, so we need to stay cautious. So the cycling, oops, this is the old one. Here we go. The trending is still unchanged. Everything is unchanged from last week. NASDAQ is bearish. ES is long-term bullish, short-term bearish. The S&P or ES is short-term bearish, long-term bullish. YM is short-term bearish, long-term bullish. Indu and Dow Jones Industrial is short-term bullish, long-term bearish. Transportation, short-term bearish, long-term bullish. Sorry, I read this wrong. Short-term bearish, long-term bullish. SPY, short-term bearish, long-term bullish. Gold, short-term bearish, long-term bullish. Likely to change here soon within the next 30 days or so. Silver, short-term bearish, long-term bullish, and oil is long-term bullish, short-term bullish. Now, let's go ahead and take a look at some of these other charts. This is, again, the ES, the S&P. Let's come over and take a look at the SPY real quick and really give you a feel. This is, again, you can see how spotty it's getting over here. We're getting a lot of gaps in the market. This tells you that we're seeing quite a bit of extended volatility. You can see that volume has stayed fairly heavy during this sell-off with these gaps. We've closed this one gap here, and you can see here we have quite a bit of downward resistance in this chart. Now, I will tell you that we're outside of this price channel. We actually now have a new channel right over here. See if I can grab this effectively. We have a new channel coming down right across here, which is going to be in play for the markets. We would, in order to get any bullish price activity, we would need to see it clearly break above this orange price channel right over here and start to move higher. We do not have that. We are in a very solid downtrend right now, and I believe this is just an exhaustion move. These yellow lines are really just more projected levels, but understand that we are in a very solid downtrend, and you can see on the SPY, my projected move is down to this 3,600 area, 36 or 360, and it really is more along the 359 to 322 support level. I will drag this out a little bit and try to move this to the right to give us room. Somewhere in this area, we're likely to try to find some support. So given where we're at right now, if you remember, if we were to follow the exact same trend that occurred back over here, we would be looking at a move from roughly this high to down to roughly this low, let's call it. And if we were to duplicate that trend from this high down into this low, we'd be targeting 339, 340 on the SPY. And that means that we're going to be looking at a potential downward price move next week and through the next few weeks in the market. Do not get married to this uptrend. It's going to look very promising in various stock sectors, particularly technology, innovation, and others. But there's a much bigger move taking place. Let's go ahead and take a look at the Transportation Index. There is a much bigger move taking place in the sense that we need to be aware of the downward price cycle. It's accelerating to the downside. You can see here how we've moved from this peak in March all the way down across this channel. And we need to see some real confirmation of a bottom or a uptrend. We're seeing extended selling in the Transportation Index, which is a measure of forward economy. We're not seeing any real strength. If you're buying into this rally right now, you need to be very cautious on Monday or Tuesday. Try to pull profits. Do not expect this to try to have any real strength behind it. You can see the buying volume here is very, very low. You don't have any real confirmation of upward trending. You can see here where we had bigger volume on the upside and the way up. Now we're starting to see very big volume to the downside as things start to accelerate. This means that we're unloading shares. Traders are unloading shares. There's no conviction to the upside yet. VIX, let's take a look at VIX. Haven't looked at VIX in a while. VIX is at 28. Oh my gosh, how is the VIX not reporting this, but still much higher than the normal levels back down around 12 or 14. We can take a look. If we go way back here, you can see that we were in the 9, 10, 11, 12. This was in 2017, very moderate. We're now at double the VIX levels here, around 10, actually 2 to 3 times volatility levels. And that's why you're not seeing any massive increase in VIX right now. The VIX has already measured 2 to 3 times volatility, and we're staying within that range. We would need to break out of that 2 to 3 times volatility to see VIX up in the 40 or 50 area again. Is it possible? Yes, it is very possible on a breakdown. So now let's come back here to the SPY and just try to give you an example of something. Well, let's look at SSO. I don't think I have too many lines on here. I got a couple lines. Okay, so now let's take a look here at monthly and understand that what we would be looking at as a downside volatility risk. So if we were to take a look at this from a standard viewpoint, I'm going to come back out to here. We really, the way volatility works is you need to measure standard deviation channels theoretically from levels like this. So let me modify and come into make it light blue, make it lighter, get rid of the distance and extend right. And now if we were to take that same channel, duplicate it, and try to move it up to this channel. So what I'm doing, ladies and gentlemen, is I'm measuring this early 2011 to 2014-15 peak level. And what I want to try to do is spread this out here to show you that the channel for that is really right down in here between 30 and call it 25. So we would potentially expect a downside move below this 32 channel, coming back down into this 25 to 30 channel in this area where this blue line is, this blue box, which should represent the, if I do this right, yeah, so this blue box here represents the 2017-18 midpoint area, and that gives us a pretty good basis for consolidation. So understand that what we're going to likely see is if this unwinding continues, we're going to likely see some sort of a downward move below this $33, $34 level down into this 25 to 30, let's call it 26 to $30 area before we attempt to find some real support. And that's going to wipe out all of these excesses from 2017 through 2021 and put us back down into normal valuation levels within this price channel that, again, originates from post global financial crisis bottom, right in this area. That'll put us back down into a normal channel where we can begin to build proper valuation and forward guidance going forward. It's going to wipe out all of these excesses. Now, is that going to happen? I say there's about a 50-50 chance it's going to happen right now based on what I understand about the economy. And what I understand about the economy is really that we need to see how the next 15 to 20 months actually plays out with regard to debt and global excess unwinding. This is one of the biggest excess cycles I've seen in my lifetime. I mean, I've lived through a few. The early 70s and mid 70s excess cycle in gold. When we went off the gold standard, I was just a young kid. I wasn't paying attention. In the 80s, I lived through quite a few excess cycles, including the dot-com bubble. And then I lived through the global financial crisis and the 9/11 crisis event. And now I think the Fed has really pumped a global bubble that we've never seen. In fact, I'm calling this kind of a hybrid dot-com and global financial crisis bubble all in one. We've seen tech, we've seen innovation, we've seen everything go crazy after COVID. It actually started going crazy right here, 2017-18, when the Fed was still very low, tried to raise rates over here, got freaked out, kept everything moderately low. Then COVID hit, kept everything extremely low, pushed out a ton of money, and we've seen this excess phase that's really just incredible. I mean, think of it. We've gone from $17, $15 on the SSO up to 80, 74. We've seen a 600% rally in about a year and a half in the SSO. And under what guidance? Do we really think the economy has grown by 600-700% globally? No. What's happened is we've just had excess everything take place. Everybody had excess money. It was like the Roaring '20s all over again. Thought nothing could go wrong. The Fed was backstopping everything. And now we need to see this unwind, just like we had in the 30s and the 40s. It could take many years to settle. All right, enough of my prognosticating regarding forward activity. I'm just urging you to stay very cautious right now. We do not have any real indication that this is a bottom yet. We are holding up in these channels. So you can see these orange channels, which come from the 2018 lows and carry across the midpoint here. So we're holding above these channels, but once we break down, literally, and you can see right over here, we've got this deep, deep low, and we've seen this pullback. Let me go to weekly so you can actually see a little more. So you can see here, we've gotten below this channel the previous week and rallied back above it. If we fail at this point and move back down into a lower channel, we're going to be targeting some extreme lows. It could get very ugly. We could move down here into 35, 36 area fairly quickly from near this $48 area. That's going to represent a huge downside move, another 20, 22, maybe 25% downside move. And you can see where measured moves actually keep us. So that's down in this $35 area on SSO. So we're nowhere safe in this move. We have not seen a capitulation bottom. There's many people out there saying that this is a bottom. You need to start buying into this. I think Bank of America was saying something about trying to buy into some of this. This looks like real solid valuation. My opinion is we need to get below this area, really down into this 2019, 2020 area, ideally down into this area before we're going to be able to find some real support. We're still going to be making money. Economy is still going to be functioning, but this is just blowing off all of these excesses. And remember, the standard deviation price channel from 2011 to 2015 says that we should, at normal ranges, be somewhere around this $25, $26, $29 area. So that could ultimately be our bottom for SSO. And it applies to all charts. If I were to come over to QQQ and do the same thing, so we'll just come back over here. Well, I already have a standard deviation channel here, but let me pull from these lows across these lows and modify this. We'll make it a light greenish color. Oh, this is moving average. We'll make it a light greenish color, get rid of distance, extend right, shrink down the line, duplicate it, drag it up to this channel, and then we come back over here and it shows us the QQQ is likely to fall down to the let's call it, as we move forward, call it the 150 to 175 level before we find any real valuation base or bottom. Now, I've drawn these areas here, which is mid-COVID and mid-2018-19. I also have this 2015 level, which I think is really ultimate base bottom support if we get some sort of a real major contagion event. But ultimately, ladies and gentlemen, we need to break down below this 225 level, move into this 200 level, and if we get into this 150, 175 level, we're looking at a very deep bottom, and this is where we would look to start buying, down into this 175 or lower, 180 or lower area. This is where you start accumulating shares and waiting for that next base bottom to start happening. So right now we're in a very early stage, mid-stage rotation. You can see a bunch of lines I've drawn. We'll get rid of this. We have broken out of this channel. We're now in this kind of a recovery phase, bouncing recovery phase. And like I said, we need to watch this. We need to stay cautious. If we start to see a downward move from, let me move here. Come on, right there. We need to stay cautious of this 303.50 level to the upside. That's going to be fairly critical right now on a downside move, and we have another one in here. And actually, we're right at it. The 295.14 area, we're at 294.61. This is intermediate peaking area. Be very cautious right now. The markets could roll over early next week and really start to sell off. All right, let's go over some of the custom indexes. So I'm going to show you this one. This is the new general large cap index, custom index. You can see we've rolled lower. I want you to pay attention to this 2020 area and see that we haven't seen the move back down to these COVID areas. So if we were to look at this, this would be COVID basing. This would be the rally in large caps through this is the monthly chart. So understand that this moves very, very quickly and shows strength and recovery in large caps very quickly. We've seen huge growth. We saw a period back over here, 2013-14, where we saw some decline. We saw a period over here, 2016. Now remember, this was an election year, and this was right after an election year. We had an election year here, 2012, and then we had this decline. This was when the Fed was still actively supporting the economy, and this went from quantitative easing to quantitative tightening or lack of quantitative easing, and then we went back to quantitative easing. So a lot of these are going to be measures of the Fed. Now we're in early quantitative tightening, and we're seeing a very strong decline in a depreciation cycle that may last through the end of this year and into 2023, possibly into June, July 2023. I believe we're going to move back down into these areas, this 1.6 area, which again is about a 20-25% decline overall. What this is going to represent is slower economy, slower spending, revision of earnings estimates going forward. The economy is still going to function, ladies and gentlemen. It's just that we are going to move from this type of an excess phase into more of this type of a cycle, meaning moderately sideways. In order for us to get there, we need to see some sort of a decline, some sort of a base, and then we're going to set up some sort of a momentum base over the next 2 or 3 years going forward. And this is where traders, global traders, may start to become concerned that the Fed is losing control or global central banks are losing control. When we start to see contagion events or crisis events, for example, Bitcoin exploding or gold and silver moving higher or copper collapsing or oil collapsing and or real estate collapsing, which we'll get to in a minute, then we may start to see some real fear enter into the precious metals markets and the bond markets, and that'll send metals and bonds sharply higher, which is what we're not seeing right now. There is no fear. People think that the Feds and the global central bank will, for the most part, be able to navigate a fairly safe landing here, which I'm not sure that's going to happen. So now this is the new TT scanner image. Show you this real quick. We still have the longs in energy holding up 19 weeks, 20 weeks, 23 weeks. We've had some pretty good trades in there. They were up higher. It's moving lower. We're very close to our stops. We're $13 away from our stop here. We are $1.60, $2.30 away from our stop here. And we are about $7 away from our stop right here. We have these new short triggers in aerospace defense. We have a new short trigger in industrial, Amex Industrial Select, XLI. We have a new short trigger in REITs, real estate. Very, very telling right now, in my opinion. Real estate's going short. And we have a new short trigger right here in semiconductors, SOX, SOXX. We have existing short triggers here in real estate, RWX, already up 8%, hit our first target. We have a short trigger here that 8 weeks old, and FDN, Exchange Traded Dow Jones Internet, is already up 13%, hit our first target. We have a short trigger here that's 4 weeks old, and biotech is minus 8%, has not hit our targets yet, although strongly thrusting downward, could be a very good signal. We have a short trigger here in jets that's 1 week old. We have a 1.5% profit in the trade already. We haven't hit any targets. Moderate downward thrusting. We have XLC, which is the Communications Select Services Group. It's 8 weeks old. We've already got 7% profit in the trade. It's hit our first target, and we've got moderate, believe it or not, upside thrusting right now. So this could be reacting to that upside price move we've seen in the S&P and the NASDAQ over the last 2 or 3 days. And then we have this trigger here that looks like it's 7 weeks old. We've already got 5%, 5.4% profit in it. This is an expanded tech sector, IGM. It's already hit our first target, and it is showing a moderate upside thrusting. So these are probably all reacting to the upside. Now see this purple trigger. This purple trigger means it's still downward overall, as well as the short signal here, but we're getting a bit of a bounce as we saw in the SPY and the QQQ chart recently. So that's why thrusting is positive here. This would be a pretty good indication that we need to watch our stop, and or if you have some dry powder, this might be a good time to add a little into these, as we're already seeing some moderate downside move here. These are fairly strong triggers. They've lasted 2 or 3 weeks. They're fairly, well, this is only $1, less than $1 away from its stop. This is 58, 56. So this is $1.50 away from its stop. You've got very little risk here. In theory, you could add a little extra to this because your stop is very close to where we're at right now, and this gives you a real opportunity that if it's right and if it's going to continue downward and roll lower, you've got a very low risk add-on right here. These new triggers, let's see, this is positive 1823, 1740, so you've got about an 80 cent range between the current price and the stop level on this. And you've got 74, 77, so you got a $2.80 range here roughly, if I'm doing the math right. And this one here, you've got quite a bit more. You've got 138 to 150. So you've got about a $12.50 range between the stop here. So again, you've got some very good active triggers here. Now you could trade the inverse of these if they're available. These are likely going to get stopped out depending on what oil does over the next couple of weeks. Follow copper and follow oil and follow transports to learn what's really taking place in forward guidance. I expect oil to continue to move lower and break below $100. It was close last week, but it rallied a little bit, just like the markets did. But I don't think this rally has really got any legs behind it. I think it's just a dead cat bounce and relief rally. So now let's move on to the custom index charts. This is the U.S. custom to global index chart. You can see we've got a little divergence going on right now. Be very interesting to see how this plays out, whether or not we see some follow through on this. It happened actually in the global index as well as the U.S. index. So we might see some sort of a little bounce here, but you can see the defined downward trending that's taking place. So I'm not sure this is the actual bottom yet. As I've shown you, I think we've still got a ways to go lower. This could be an early warning sign. But again, we need to watch these lows. We need to watch what happened at recent lows and watch to see if it moves lower, which is what I believe is going to happen. This is the global asset index, which is measuring the decline in global assets. We can see we've got very strong downward trending. Very strong downward trending here. Lots of volume kicking in, but we don't see any real measured price decline, which is why I think the markets have yet to have a capitulation moment. So I'm going to warn you that I kind of am looking for this to move back down into this area, this 0.80 area. And what I think is really going to happen is we've got to get back into these 2018-19 levels, wash out all of this excess before we find some sort of a decline. Now, it might be a spike event, or it might be a protracted or prolonged event like this that rolls down here, but we need to see if we do a quick measurement. So we would call this 6, 6, 12. This would be about a 22 to 25% decline to get us back down into these areas in the U.S. and global markets from where we're at right now. And that really is going to be global assets. It's going to be basically everything. When you think of it from an inflation standpoint, we need to see prices revert back down into normalized price levels back in this area, which is a 20 to 25, maybe 30% decline for houses and oil and almost all levels of assets. That'll give us a solid base to move forward from. The depreciation cycle phase, you've seen this, it falls into my charting here because of the name we have. But this shows us here gold. This is from a couple months back, but this shows us the real cycle phase of gold. We're down in this, let's see where gold is, 1828, almost very close to where we're at now, down in these lower areas here. This is really where gold is. We need to see fear come into the market. We need to see some lack of confidence in global central banks and the ability of the markets to hold up where they're at before gold's really going to rally. But a lot of people are talking about how this is going to play out, and in my opinion, it's inevitable. Gold and silver are going to move incredibly higher over the next 4 to 5 years, but it's just a matter of time, in my opinion. We're just not seeing that fear cycle yet. I mean, if you look at this, this is really gold moving higher. This was extreme fear through the 2008, 9, 10 crisis event where everything seemed to unwind globally. Now we've got this rally back up to this area. Before we had even COVID, we started seeing this move in early COVID, before COVID, and then it peaked near the COVID period. And now we're in this move where we're holding up very, very well, but we just don't have the fear in the global markets yet. It's coming. In my opinion, I think it's coming. We're waiting for that next shoe to drop, that next crisis contagion event. And I believe it's going to come in Asia. I've told you that many times in my videos, but I believe it's going to come in Asia. Now with the war between Ukraine and Russia, that puts Russia and Europe in the area for some sort of a contagion event as well. So we just need to stay cautious and wait for the move, which is why I've got you positioned properly. The Bradley Custom Gold Cycle Index shows a nice upward move here last week. This is monthly, so last month. We're in June still. We're seeing this upward move. Let's see what happens through the end of this month. If we get above this area here, this consolidation channel coming across probably around 40-41, then we're going to be off to the races. As long as it stays down into this lower channel, kind of basing down in this area. In fact, it's fairly similar. Not really, though, because we had this base here. We're kind of in this mode where we've gotten a little higher. You can see here we've gotten a little higher. We may see some consolidation before fear really kicks in. We may see this roll a little bit lower for a couple more months before fear kicks in. But my opinion is by October, November, December, we're either going to be looking at a fairly safe landing for the Fed or quite a bit of chaos. So we only have 2 or 3 more months before we're going to really see what's going on. And again, once we get above this 41, 42 area to the upside on this chart, gold and silver should really start to accelerate. Okay, current real estate. This was updated just this morning. Pay attention to this. This is just ungodly. I was recommending back over here when I started tracking this data that price reductions should continue to climb, but I don't know how, honestly, I don't know how price reductions can move to 1.12, which is where they're at right now, of total market capacity. This means that new homes are coming on the market, which you see here. Active listing counts are just skyrocketing right now. Price reduction shares, which is this blue line, is skyrocketing. Prices should start to really decline. I mean, we're going to see a big decline, possibly even sharper than COVID. But price reductions right now as a share of market is measuring at 1.12. That means 112% of the houses on the market are in some sort of price decline. Explain that to me. That means that basically everything's coming on the market and being reduced right away. And that's what it's basically telling you. Everything is being reduced. Sellers are dumping houses trying to get out at the highest price ever. So now we need median days on market is climbing. You see it kind of stalled last week. And median price listings has moved a little bit lower, but still holding up there. There was news last week that new home sales jumped up 10%, but I want you to understand that that's after many, many weeks of decline. So by my measurement last week, new home sales were off 28%, 26% from extreme highs put in just about 2 months ago. So that means that new home sales are down right now about 17 to 27% overall, and this is what's showing up. We're seeing a massive global dumping of U.S., or I don't want to call it global, but a massive U.S. dumping of U.S. real estate. Everybody's trying to dump out of the market as high as they can right now, and this is likely going to turn very, very quickly. If the Fed continues to raise rates or some contagion event happens, this could get really wild. Next, we have the Bradley Custom Consumer Engagement. Excuse me. This is stalling out here. Remember, this is monthly. So this is our last month, and this is current month here, June. It's stalling. Consumers have pretty much not made any major changes compared to what happened last month. This was really the shock of the Fed moving, the gas prices moving, pretty much the shock of the big sell-off that we had over the past couple of months. And I need you to understand that consumers have really not budged right now. They're in a protection mode. Think of it as a hunker down, try not to spend, and just see what happens. So we need to see some engagement here. Either consumers start to engage in the economy through summer, or they move into a downward cycle trend, which means that consumers are moving away from the economy more aggressively. When you start to look at this and sales activity and what's actually going on, you're seeing higher home price active counts, more homes coming on the market, less homes actually selling, higher price reductions, skyrocketing number of reductions on a year-over-year count. This is basically telling you that the market is getting flooded with inventory at lower and lower prices, and consumers are just not moving. They're not taking any major risks right now unless they have to. Next, we have the technology ratio index, stalled out again. This is a monthly chart as well. This is telling us that we may be finding some support in technology. I think we're still going to see a washout move. As I mentioned to you, we're still too high overall. Even though this is really, measuring technology and measuring kind of like the Fangs stocks, the leaders in technology, I think we need to get down into this 26, 27 area, down into this area to see a washout move, which will put us from these 2014-15 lows down into these 2011-12 area. But I think that really technology could be the leader coming out of this. I think we're just too early right now to be buying into it. I don't see any real strength with regards to technology. I think that we need to continue the unwinding process before we're going to find any real value trying to buy into an early stage bottom. And this is the global market index again. Okay, so now we've covered these. Let's go to here. This is the Fangs index, custom index. This is available in your TradeTank weekly report area. You see this nice little bounce. Okay, this was the bounce we had last week, but you can see we've got it on diminished volume here in a downtrend. We're just now back into this upper channel, which was from post-COVID. Remember, this is a standard deviation channel. We're still in this upper area. We're still looking at, I want to call it complacency buying. This is people thinking, well, we've seen enough. Now let's try to buy into this bottom. It looks like it's a pretty good value right now. What people are really missing is the fact that the unwinding is likely to continue if the Fed continues to operate and try to raise rates and burst inflation. Consumers are pulling away. You're going to have revised earnings. You're going to have devaluing price assets. So you need to be very clear that this could move right down into this 400, 350 range. And remember, from where we're at 550 or 522, this would be another 20 to 25% or more downside move to rebound off of these levels, which is what happened back here in COVID and what happened back here off of the 2018 lows. So we're unless you're willing to risk potentially a 15 or 20% downside move for a long-term position, I would not recommend buying into any technology sector or trying to front run what you think is a potential bottom right now. Wait for it to form. U.S. stock market index is showing the same thing. You can see across this 2018 low, moves right across the middle of COVID, and I'm drawing this off of this lower standard deviation channel. We're right now at this lower standard deviation channel, but I think we need to potentially move down to this area here that I've drawn in red, which is kind of this yellow line, this 900. We're at 1055. If we were to move to 900, that would be about another 10%. Do the math right. Yeah, a little over 15% downside move to this area, maybe a 20% downside move into this area. And this is, again, why I think we're in this area is the real target area for buying. I think we're way too early at this area to look for a bottom. I think the Fed's willing to do whatever is necessary to curb inflation and to stall the market. And I think we're way too early right now in this move to start looking for a bottom. The smart cash index, which is the global, is kind of just showing very weak trending here. You can see the RSI is stalling out. Stochastics has moved a bit lower. We're in this middle channel area. We could see a bit of a washout low into this 130 area over the next couple weeks, but we're basically stalling in a sideways channel. Traders, again, are somewhat complacent, trying to look for a bottom, trying to front run what may be an early stage base in the market. I would urge traders to stay very, very cautious and wait this out. My feeling is the next 2 to 3 months could be very telling as to whether or not we're going to have a deep, deep bottom or whether we're going to have some sort of recovery. Remember, global central banks want to burst this inflation bubble, and that could lead to a number of credit and liability issues globally going forward. Next, we have the metals index. Okay, metals have really, again, not started to see an upward move. They're stalling, which happens in a downward trend. You can see during COVID, which was way back over here, how metals stalled and really based. You can see also at other times when the Fed was actively engaged in trying to prompt the market, you can see metals just really fall out of favor and stall. I do believe this is a very solid bottom. We've been kind of below this channel for a couple of months here. This is weekly, so a couple of weeks. Long and short of it, I think we're really getting very, very close to a nice recovery move here in metals, but you have to stay patient. In reality, ladies and gentlemen, these recent lows, which for gold would be like 1800, 1780, and for silver would be like 21, 22, 20 to 21 roughly for silver. Those levels need to hold. If we see a big unwinding in metals, in reality, if you're holding a lot of metals and you don't mind taking the risk, which is me, I've been buying silver and gold since 2014 and 15, and long and short of it is I have already, maybe 45% profit in my metals. Long and short of it is I'm willing to hold it. If you're not willing to hold it, then get out, try to buy at a lower price when you're prepared. But this is really building a very strong momentum base right over here, kind of like we did right over here. If it's holding up and not creating new lows off of this low right here, then we are looking at some sort of a skyrocketing explosive event back up into this area, which would put gold and silver above recent highs. You'd be looking at $2,100, $2,200 gold, possibly $28, $30 silver. And this is really forming a very solid base. With no newer lows, I can tell you that it's failing to establish a new lower low at this point. We just need it to get above this recent high area, which could be over the next week or two, and start to really rally. Okay, we have this very strong bullish trigger here, but we need to see some follow through to the upside, folks. Next, we have the Valuations Index. And you can see that we're stalling down here in the middle area. We're just not seeing really any momentum to the upside. That's one of the reasons why I think this rally in the recent stock market is really just a failed bounce, a dead cat bounce. We're seeing no real momentum to the upside. We need to start seeing some kind of upside momentum here, and we're just not seeing it. We're not seeing any real accumulation here. Everything is moving lower. Everything is in a downtrend. Until we see any real upward momentum in the economy and valuations, I'm not going to be looking for any long-term positions. You can start to buy into things if you want. Just remember, there's a 15 to 25% downside risk ahead of you if my analysis is correct. Waiting another couple of months to try to buy 15, 20% lower would be a much smarter decision. Commodity to gold index doing the same thing, stalling out, really trying to show some support down here in this area, but I'm not seeing it yet. I'm not seeing any real support. If we see it, the commodity to gold index would start to move back above this 2.0, 2.2 level, but we're not there yet. We're just not seeing any real strength or capitulation to the upside. Everything is still unwinding. Next, the volatility index. We had a nice solid bounce off of this level. Nothing aggressive. So understand that we had a move here of maybe 10, 15% to the upside, but we're still in this downward channel. We're still consolidating downward. We have nothing to the upside, in my opinion. This was a very minor upside move in the markets last week. I don't see any real momentum behind it. If we did, I would have expected this to come back up above this level here, but we just don't see it yet. So my expectation is we might see Monday a little follow through, a little consolidation, a little support, and then we're going to roll back over potentially move to the downside. Okay, I think that's it for these. Yep, that's my longer term 5-wave completion to a top. Now, this was done in 2021. It's very interesting that I was telling you that we had a wave 5 completion, which as I recounted turned into a wave 4 completion. Now we're looking for a waveform base back over in this area. Remember, we are already down in this area with regards to the SPX, the S&P 500 index. So we're already into this 3,600. Let me take a look. Yeah, we're at 39, 39, and 39. So we're in really this area where this yellow line is. And what I was telling you is that we would likely see a peak up over here, and we would likely move down to this 2,800 level trying to find support. So understand that we're at 3,900 on the S&P right now, 3,914. And this is telling you that we've got potentially another 1,100 points to the downside before we find support. And this research was done back in, it looks like, I would guess here probably June or July of 2021. Let's see if it tells us May, actually right here, May 31st, 2021. Anyway, I hope you're enjoying my research. Follow me on Twitter. It's all on the website, ment.com. And pay attention. We've got a lot of real craziness going on. I want you to understand that this... Oh, no, wrong one. Hold on. This is Bitcoin from a while ago. This is bubble burst Bitcoin. There's the Fangs index. Come back over here. Come back over here. This, real estate conditions, is one of the most telling signs that we're nearing not necessarily a global financial crisis like we had before, although it could happen, which is why I'm concerned about Asia and Europe. Remember, we had a huge rally of real estate in Asia and Europe after the 2008, 9, 10 collapse in the U.S. markets. U.S. banks have been subject to the stress testing, which means we're in a bit better scenario than some of these other markets. But for example, Asia and Europe have seen incredible price rallies in real estate over the past 6 or 7 years. And a lot of it has been banked on, you know, just really excess lending, particularly in Asia. Not a lot of people understand that, you know, it's basically been buy a house, wait a couple years, refinance, buy another house, wait a couple years, refinance, buy another house, refinance, or 2 or 3 or 5. And even though they're tied into a lot of money is just pouring into these real estate values in full cash purchases, we could be looking at a 40 or 50 or 60% decline in real estate values in certain areas and a real unwinding of that leverage. So understand, a lot of people have got a ton of money that they're used to living with, maybe millions or hundreds of millions of dollars in real estate. If something were to unwind 40, 50, 60%, these people would be very, very concerned about the growth and the valuation of their real estate, and they're trapped in these real estate investments because nobody wants to buy when the market is contracting. So this is showing us just U.S. selling is becoming aggressive at this point. Look at these levels. This is the highest level of reductions we've seen in, you're going back almost 10 years, or sorry, 5 years here. We've got the highest level of active listing count since early 2022 with this blip. I mean, if you were to ignore this blip, this is the highest level of active listing count going back over the last 5 years. You've also got the highest price level in the last 5 years, which means everything is overvalued. And you've got the price reduction shares increasing dramatically, days on market increasing or starting to increase dramatically. We're really looking at a cataclysmic shift in the real estate market, which I believe is taking place globally. So we need to just wait this out right now. This could turn into the next big shoe to drop over the next 60, 90, 120 days going into the end of the year, depending on what the Fed does and how the markets really react. Now, the other thing we need you to understand is this consumer engagement. Consumers are paralyzed right now. They just don't know what to do. The higher income consumers are still engaging in buying and they think that everything is just fine. The middle and lower income consumers are just paralyzed. That's what this is telling you. They're almost in shock. They don't know whether to run. They don't know whether to come out and start buying. They don't know what to do, which is why consumers are pulling away from the stock market and the asset market and moving into a protectionary or a protective stance. So we need to kind of get some clarity over the next 2 or 3 months to know what's going to happen before we make a decision. All right, guys, that's it. A little long today. Hope you enjoy it. Follow me on Twitter and YouTube, and we'll go from there.